Thank you all so much for your patience. I believe we will begin our training now. And our moderator for the day is none other than our commercial director, Florence Moshiri. So, Florence, the floor is yours. Welcome.
Okay, thank you very much, Elizabeth, and good afternoon, everyone. Welcome to this session this afternoon. As a very interesting session, a topic where we are going to dissect the NSSF Act of 2013. Before I dive into the session with me, I would want to quickly introduce a colleague who I'll give a chance to quickly say his name and his position. And then the other two who are speakers, I will introduce them during their sessions. So welcome, Davis.
Thank you so much, Florence. Just to appreciate everyone who managed to be here today. My name is Davis Ongiro. We are glad to have all of you here, and we wish all that it will be a good opportunity for us to learn. And feel free, in case you have any questions and queries, we'll also be available to clarify. Thank you so much, and all the best.
Thank you, Davis. Once again, welcome on board, everyone who has managed to log in this afternoon, that we may be able to go through this particular interesting topic that is on the discussion right now and a concern for every employer and employee. Before we dive into the topic, I want to briefly first explain who we are as Octagon Africa for the benefit of somebody who may have logged in and has not heard about Octagon Africa. Octagon Africa, we are a pension administration firm, and we have been around since 2007, and we are not the only standalone pension firm. There are several pension firms, as majority of us may be aware. Right now, we are talking of about 19 to 20 standalone institutions that actually are pension administrators. But however, we happen to be a pension administrator that has been there for a very long time. And we are not only in Kenya, we have footprint in other countries beyond Kenya as a region. In Kenya, we have offices in Nairobi. We are based at the West Park Suites along Ojiji Road, that's in Westlands. Then we are also having an office in Kisumu and an office in Eldoret. Besides the two offices that are here in Kenya, you can easily reach us virtually because technologically we are really enhanced technologically. So we may not have many offices all over the country, but we use the technological space to be able to communicate with our clients and to reach out to them. Beyond Kenya, we are also in Uganda and we are also in Zambia. Actually, in Zambia, we bought off a partnership, we bought off Alexander Forbes, and we established ourselves in Zambia. We do have a partnership with Alexander Forbes, however, within Africa, and we represent Alexander Forbes here in Kenya and beyond Kenya within Africa as a continent. We are glad to have you, and we would want to explain a little bit more about us. And that's why I said I would give a chance to a general manager who is on board. And one of our speakers, Ruth, is also a general manager, client services, as Davis is the general manager in terms of business development. Our group CEO who began this institution is known as Fred Waswa. He is our group CEO and has been in the business for a very long time. And he started in the 90s. And therefore, he has knowledge, expertise, and is an authority within the pension administration industry. Glad that to say that in the industry, as much as I said, I know we are not the only standalone pension administrator. We emerge strong because we come out at number 3 within the standalone pension administrators. And we are proud about the technological space that we have because we emerge number one within the technological space in terms of ensuring that we offer you services at the comfort of your homes, comfort of your offices, wherever you are, you can easily reach Octagon Africa. It is an application that we do have that you are able to access through the website. And we have a member portal, we have a HR portal, we have a portal for the administrator, and members can access the system and they are able to actually view and see their statements online, raise queries online. Then the trustees can be able to authorize online because there's also a trustee portal, there's a sponsor portal, and therefore everything in the technological space then makes things very easy and comfortable for everybody. We are able to therefore realize the turnaround time in a very short time. Like, for example, if we are paying off benefits, we can pay off benefits within a period of 3 to 5 days, and that makes the members and the trustees very, very happy. Enough of introducing Octagon Africa, and because of time, allow me to therefore introduce to you who our guest is. Our first guest will be Stella Musembi and Ojango. Those are her full names. She's a partner with GVA and the head of Farms in Nairobi office. Stella is has a distinguished track record for over 12 years in the delivery of legal services and cybersecurity, data protection, intellectual property, corporate and commercial law, real estate, and property acquisition. I know that is such a mouthful, but I know Stella has a world of knowledge that she'll be able to share with us. In terms of environment and climate law change, she also has some experience and skill. And when it comes to employment and pensions law, she really has an edge on that. She has in the recent past trained and advised various organizations on data protection, prepared and reviewed data protection policies, as well as issuing legal advisory on retirement benefits and related issues to several retirement benefit schemes. And of course, in the private and public sector, including the corporates, and she's looking up to setting up schemes. Stella has a degree from Moi University and a diploma from Kenya School of Law, and she's currently pursuing her master's degree in the environmental space. She's actually a certified trustee and has undertaken the TDPK, that's the Trustee Development Training Program. She's a council member of the Association of the Retirement Benefit Scheme, a member of Data Protection Committee of the International Trademarks Association, and a member of the Law Society of Kenya. And she serves in the board of Mission Campaign Network. So as we speak, that Stella is an authority in terms of pensions and has a wide knowledge about that. A little bit of her career. She definitely, as a person, has a passion about the environment. That's one of her hobbies. And she loves outdoor activities. And therefore, welcome Stella on board to this session so that you can then take us through this session. And that's Stella. So good afternoon, Stella.
Good afternoon. Thank you very much for that amazing introduction. Glad to be
Welcome.
here. Thank you for the opportunity to take the members who are attending, trustees, other service providers through the NSSF Act 2013. It's a pleasure to be here. And without further ado, allow me to start sharing my slides and move on straight to it so that then we can unpack this Act of 2013. So now I believe we all can see my screen. Lawrence, please confirm. Please confirm, Florence, that you can see my screen.
Yes. Sorry, Stella. Yes, we can see your screen.
Thank you very much. So as introduced,
Welcome.
Stella Musembi Ojango, a partner within Dikera and Vagama Advocates. Glad to be taking you through the NSSF Act 2013. And I will be moving on to talk about the history and genesis of this particular act before venturing into the act itself. So the act was passed or assented into law on the 24th of December 2013 by the former president, Uhuru Muigai Kenyatta. The act commenced on the 10th of January 2014. But as it came into commencement in 2014, the act was challenged, as we all know. It was challenged, and it was challenged before the Employment and Labor Relations Court. So following the challenging at the Employment and Labor Relations Court in 2014, it took several years, actually up until last year, 2022, September the 19th of 2022, for the court to make a determination. And the court did make a determination, that is the Employment and Labor Relations Court. I will not venture into that determination. But what I will say is that that determination was appealed to and the appeal was filed at the Court of Appeal. So the decision of the Employment and Labor Relations Court, having been appealed to the Court of Appeal, the Court of Appeal had to sit and look through the decision of the Employment and Labor Relations Court. The Court of Appeal, the appeal was filed last year, 2022, but the court did make a determination this year, and it's specific on the 3rd of February, this particular month, nullifying the decision of the Employment and Labor Relations Court. And the main reason for that nullification was jurisdiction. The court found that the Employment and Labor Relations Court had no jurisdiction to entertain this matter or to entertain interpretation of this particular act. So with that, the court then found that the act is actually valid and it is law in Kenya. Consequently, on the 9th of February this year, 2023, the NSSF issued a press release on implementation of the act, asking employers to comply with the act with immediate effect. So following this, we now venture into the act, because this is the law that now governs social security in Kenya, that governs matters savings under the National Social Security Fund, and how it then affects us as employers and employees of organizations. So I move on to the salient features of this particular act. And I have pointed out about 6 salient features. And that is the act establishes 2 funds. It brings about the aspect of mandatory registration of employers and employees and the issue of mandatory contribution. Then it creates 2 tiers of contributions. It also opens opportunity for voluntary membership and contribution for self-employed persons. And then it also introduces the aspect of contracting out or opting out by employers. And then, of course, it imposes certain penalties and fines for non-compliance. So for the purpose of this presentation for today, we will be looking at those particular aspects. And finally, we will also be looking at access of benefits. We're looking at access of benefits, the 2-tier contribution, investment, where can the fund invest, who supervises the fund, how is the fund audited, and how can members of the fund access benefits. So that is what we will venture into, even as I move on to my next slide. So now we will look at the aspect of mandatory registration and contribution. So before I venture into that, I have to mention that the Act establishes 2 schemes. It establishes a pension scheme and a provident, or let me call them funds, a pension fund and a provident fund. Those are the 2 funds that are established under the Act, under the NSSF Act 2013, Provident Fund and Pension Fund. Then every employer who employs 1 or more employees, the bare minimum is 1 employee. So long as you have 1 employee or more as an employer, you must register with the fund as a contributing employer and contribute to this particular fund. So once you are an employer, you contribute into the pension fund or the pension ambit of the fund, because we have said it has established 2 schemes, a pension one and a provident one. So for all employers who have 1 or more employees, they contribute into the pension ambit of the NSSF. So any person who is registrable as an employer must by law provide proof of registration with the NSSF to deal or access public services. So this was one of the reasons that this act had been challenged at the Employment and Labor Relations Court. But now that this is law, if you are to access public service as an employer, you must demonstrate that you have registered with NSSF for purpose of contributing for your employees. Self-employed persons. Self-employed persons.
Hi, Stella, there is an interruption. If you can kindly put the slides on presentation mode.
I have now put them on presentation mode. Is it good?
Okay.
I have put
Yeah,
them on
it's good now.
presentation mode.
Yeah,
Yeah.
proceed, yes.
Thank you. Yeah, so mandatory registration and contribution. So I had mentioned the aspect of two funds established under the NSSF. I have mentioned the aspect of every employer who employs one or more employees must register. And then I've moved on to say that as an employer, for you to access public services under the Act, you need proof of registration. So self-employed persons can also contribute to the fund, but now they contribute on a voluntary basis as voluntary members, and they contribute to the Provident Fund, not the pension one. So they contribute to the Provident and not the pension one. That's for self-employed individuals. Then any employer who fails to register commits an offense and is liable upon conviction to a penalty of 50,000 or a fine, actually. It's a fine of 50,000 upon conviction. So that's how serious it is. We urge employers to register and comply in terms of contributions so that then they avert this issue of non-compliance. So when it comes to contribution, the NSSF Act has provided the rates of contribution. So employers are to contribute 6% of the employee's monthly pensionable earnings, and the employee is to contribute 6% of the employee's monthly pensionable earnings. So it's 6% of monthly pensionable earnings. The Act has defined pensionable earnings to mean earnings that are, allow me to actually provide that as provided in the Act. So pensionable earnings means pension fund, means for a pension fund member, the lower of the member's monthly wage under the upper earning limit. So it's the lower of the member's monthly wage under the, and the monthly wages and the upper earning limit. So there's an upper earning limit compared to the lower of the member's monthly wage. We'll venture into that as we continue, but that is what pensionable earnings mean. So employers who fail to deduct employee contribution will be required to pay for both employee and employer contributions from their own resources. So there is no excuse. If you do not deduct from an employee as an employer, then the law deems it or requires you to then contribute for that which you did not deduct from the employer's resources. So that's how serious it is. I will urge employers to deduct and meet. So the law provides for 2 tiers of contributions, that is tier 1 and tier 2. So tier 1 contributions applies to pensionable earnings up to the low limit, while tier 2 contributions applies to pensionable earnings above the lower earning limit. And one will ask, what is this lower earning limit? So the lower earning limit, as per the Act, has been defined as the monthly, the minimum, the statutory monthly wage that is gazetted, statutory minimum monthly wage that is gazetted by the Cabinet Secretary from time to time. So the minimum statutory basic monthly wage as is gazetted from time to time by the Cabinet Secretary. So that is the lower earning limit. So tier 1 is pensionable earnings up to the lower earning limit, up to the basic minimum wage that is gazetted. And this basic minimum wage is normally gazetted for urban areas, second tier urban areas, and rural areas. So the minimum wage, if you're in a rural area, may not be the same for a person who's in an urban area or a person who's in a second tier urban area. So the Gazette notice actually does specify that and show the different minimum wage for the different areas within the country. So tier 1 contributions are to be credited to the employees' tier 1 fund credit, while tier 2 contributions are to be contributed to the employees' tier 2 fund credit. And this is important because these two fund credits are provided for separately and reported for separately because of the aspect of opting out. I will talk about opting out later, but it's important to know that these two funds, the tier 1 and the tier 2, are reported separately, even though they belong to one particular member. So failure to remit contributions within a month, so failure by an employer to remit contributions within a month, at the end of the contribution month, comes with a penalty. And this penalty is 5%. It's quite a huge penalty. It's a penalty of 5% of which 5% is to be added to the amount that had not been contributed. So say if in a month an employer is supposed to remit, say Kenya shillings 1 million, and they fail to remit that 1 million, then if a month lapses, but it's a month from the month of contribution, if a month lapses from that previous month, then 5% is added to the 1 million. That will become 1,050,000. And then that amount will be owing, and another 5% will keep being added for each month until that amount is repeated. So non-remission is serious. It attracts a penalty of 5%, which is added to the amount owing for each month that the amount remains outstanding. And then moving on to the next slide. Allow me for 1 minute to escape. Give me a minute. So contracting out, what is contracting out? Employers are under the Act allowed to contract out, but the employers who can contract out are employers who are registered as schemes under the Retirement Benefits Authority and also by the Kenya Revenue Authority. So if you're an employer who has a scheme, they're calling it a contracted out scheme. If you're an employer who has a contracted out scheme, and a contracted out scheme is a pension scheme, either occupational, either umbrella or individual, that is registered with RBA and the Kenya Revenue Authority, you're then allowed to contract out. And this contracting out only applies to tier 1. So you cannot contract out of tier 1 contributions. You only contract out of tier 2 contributions for your employees as an employer. But as you contract out, you can contract out for all the employees or part of the employees. So the form, that is form C1, which is the form that is filled out and submitted for purpose of contracting out, allows you to state which category of employees you're contracting out. You either say you're contracting out for all employees, and if you're not contracting out for all employees, probably you have employees who are on contract, who are ordinarily not even members of the scheme. So for those ones who are on contract to get a gratuity, those ones you may not be able to contract them out because they were not members of the scheme by virtue of the trusted employees. So for those ones, then you can indicate that this particular category of employees will not be contracting out. So when you apply to contract out using the statutory form C1, that application is made to RBA, or Retirement Benefits Authority. The application is not made to NSSF. And for good reason, because NSSF will ideally be conflicted because they are the fund receiving the tier 2 contribution. So to avoid that conflict, the law provides that that application shall be made to the Retirement Benefits Authority. And then as you apply using the form C1, that is not the only form, that is not the only document that you will submit to the authority. Over and above that, you will require additional documents to accompany this form C1. So that the form C1 is the application form, then you have certain supporting documents. So we have the NSSF contracting out regulations that speak to this. And they speak to the additional documents that need to be provided. These regulations are of 2014. contracting out regulations. So they provide the additional documents that need to accompany Form C1. Some of the additional documents is a resolution by the employer that they have resolved as a board. I believe most employers also are boards. The board of the employer has resolved to contract out, and it has resolved certain employees or all the employees. So your resolution should speak to that. Prior to that resolution, an employer is expected to circulate a notice to all its employees, notifying them that the employer intends to contract out of NSSF. So that's one of the documents that you need to produce, the notice that was circulated to all the employees stating that you intend to contract out. And then, of course, that particular resolution. Number two, the employer has got to undertake to comply with the obligations concerning minimum payments. And the minimum payments are the payments for Tier 2. So the employer has got to undertake that even as they contract out, they will remit the Tier 2 payments to the contracted out scheme or to their pension scheme that is already established, either an occupational, or if they don't have an occupational, the umbrella that they contribute to, or the IPP that they contribute to. And of course, over and above that, the trustees of that particular scheme, the ones that are receiving the funds for the Tier 2 funds, have got also to resolve to receive those funds, that they've agreed to receive the Tier 2 funds. Then the administrators of that particular scheme also need to give an undertaking that they will comply with the provisions of the Act, and that is with respect to reports concerning Tier 2. Whenever you are giving member statements, the Act, the NSSF Act, seems to provide that the Tier 2 contributions need to be reported on separately, so that the administrator undertakes to comply with that. That's just a few amongst the documents that you will need to provide to accompany Form C1. Actually, the documents listed under Regulation 7 of the contracting out regulations are not less than 15 or thereabouts documents listed to accompany. Of course, some of them are very low-hanging documents, like the name and the address of the employer, categories of employees that want to opt out that we've already spoken about, the list of employees that will be exiting from the NSSF fund. So all that needs to be provided and needs to accompany the Form C1. Then the Form C1 has 2 dates, and these dates are important. The first date is the application date. Just like any other form, it should have an application date. But then number 2, it needs to have an opting out date. This opting out date is supposed to be 60 days from the date of the application. Dated 1st March. Then the opting out date can only be, say, 30th April. So that then 60 days have gone in from the application date. Then for a scheme to qualify to receive Tier 2 contributions as a contracted out scheme, they must meet the reference scheme test. So you see, once you apply to RBA to be contracted out and you submit your Form C1 as an employer, together with the accompanying documents under Regulation 7 of the contracting out regulations, then the RBA will look at your application against a certain test. And that test is provided under the 4th schedule of the NSSF Act. So number 1, it's a very low-hanging requirement. Number 1, the contracted out scheme or the pension scheme where the Tier 2 contributions will go needs to have been registered with RBA. Number 2, it needs to have been registered with the Kenya Revenue Authority. It needs to have an investment guideline that aligns the Retirement Benefits Act guidelines. That is an investment policy statement aligning to Table G of the Retirement Benefits Act. Of course, it needs to comply with any other prescribed requirements by the authority, the reporting requirements under the Retirement Benefits Act. And then it also needs to be a pension scheme. Remember, Tier 2 contributions made by an employer who has 1 or more employees go to a pension fund or a pension scheme established by the fund. So they are saying if you're contracting out, the entity that is contracting out needs also to be one that provides pension or income drawdown as a benefit. and the one that has the capacity to allow for protected rights of the contracted out tier 2 members. And what are these protected rights? The right to be able to transfer. So it's a right of portability. The right to be able to transfer from one scheme to another. So if a member is today a member of pension scheme A and they cease existing or they cease being employees of that employer, then if they move to another employer who's employer B, they need to, the pension scheme trust deed for A needs to allow them to carry their, to transfer their benefits to their other fund. And if where they're moving, there's no pension scheme, then to transfer their benefits back to the NSSF. So that aspect of portability is a requirement, and it's one of the tests that RBA will be checking even as they allow the application under Form C1 for contracting out. So contracting out continued. So RBA is mandated by law to determine that application within 30 days. And when I say law, I'm talking about the NSSF Act. So they are mandated under the NSSF Act to determine the application within 30 days. And remember, when we say determine, they can allow or decline. But where they decline to allow us, an employer, to contract out, RBA is required to issue, to give written reasons for declining. So once they accept, they then give the institution or the employer a contracting out certificate. Issued in respect of a scheme shall be valid from the date of issue until the scheme is registered. So number one, a contracting out certificate is issued. And once you're given that certificate is valid until the scheme is either deregistered or wound up or the contracting out certificate is cancelled. And there are various grounds for cancellation. It may be that there are certain requirements that were probably skipped and you had not met. So when that is realized, that certificate can be cancelled. But once you are given a certificate, that certificate is valid for life until the scheme is either deregistered or wound up. So an employer issued with a contracting out certificate shall then apply to NSSF to transfer the tier 2 funds. Because remember, before the contracting out certificate is issued, the employer is still contributing tier 1 and tier 2 to NSSF. But once the contracting out certificate is issued, they now can only contribute tier 1. Tier 2 is what they can contract out, and they need to apply to NSSF to have that money transferred now to the contracted out scheme. The contracted out scheme is the occupational scheme of the employer, the IPP or the umbrella that the employer is in. So once they apply, the transfer by law, by law, that means the NSSF Act provides that the transfer should be made within 60 days of that application to transfer. But that transfer shall not include interest. So if there was some interest that has accumulated for that money that was at the NSSF, the transfer shall only be of the principal amount, not the interest. And I must mention that the NSSF Act provides for allocation of interest annually. So even if you apply at the end of a year and the interest has already been allocated, you still cannot get that interest. The law says that the transfer shall not include interest. The only amount that will be transferred within 60 days is a principal amount that had been sent to the fund, the NSSF fund under tier 2. So contracted out schemes are to furnish RBA with quarterly reports, confirming tier 2 contributions received, interest paid, or received on delayed tier 2 contributions. So the normal way that schemes report about funds that they have received from the sponsor that the sponsor has remitted, now they will still report, but now specifically for tier 2 contributions. How much have they received for tier 2 contributions, and where there was delayed remittance of tier 2 contributions, interest that was levied, and whether that interest has been paid. Now, the Act, and in specific the regulations, provide that RBA is to in turn provide quarterly reports to NSSF on the status of tier 2 contributions for schemes that are contracted out, or for contracted out schemes, and any arrears. So as the scheme is reporting to RBA, RBA is also mandated under the regulations, the NSSF regulations for contracting out, to report on a quarterly basis to NSSF on tier 2 contributions. So let's move on to investment of member contributions. So we have members have contributed 6%, the sponsor has contributed 12%, or the employer 12%, making it 6%, making it a total of 12%. So this 12%, when it hits NSSF fund, when it goes there, it needs to be invested. The law says that any money that is not immediately required by NSSF should be invested in line with the provisions of the Retirement Benefits Act. So understood for schemes that are already complying with the RBA regulations for investment. We have the table G that guides on investment. So these funds that have been transferred by the employer, the 12% to the NSSF, are then invested in line with the Retirement Benefits Act guidelines on investment. I have to say at this point that we have the old, the NSSF Act 2013, as I mentioned earlier, establishes two funds, a pension fund and a provident fund. But prior to 2013, we have the old NSSF Act, which was repealed. So that old NSSF Act had a provident fund, or that fund is actually a provident fund. So the new Act calls it the old fund. Whenever you see the term old fund in the NSSF Act 2013, it means the NSSF Act prior to fund prior to 2013. So that old fund is now to operate as a closed fund. The second schedule to the Act provides for that. It's actually called the transitional schedule. It provides for that. So the funds under that particular, those monies that we were contributing, the 200 from the employer and 200 from the employee, making it 400, those funds, the law says, will remain in that old fund. That old fund will not receive any money going forward. So any monies that we pay as of 9th of March, because that's the time, the timeline for remitting funds to NSSF, shall now go to the new fund. Any monies that were paid prior to March of this year will be in the old fund, which will operate as a closed fund. So it shall not receive any fresh monies. It shall operate as a closed fund, and members can only access monies there when upon attaining retirement, or as per the provisions of the old NSSF Act. So that one is actually a closed fund. It will no longer receive monies because now we have established two new funds, a pension one and a provident, under the new Act. So let's look at supervision and management of the fund. So the fund number one has, the Act establishes the National Social Security Fund Board of Trustees, and it sets out the individuals who shall sit under this Board of Trustees. And this Board of Trustees also that is mandated to supervise and manage the fund on a day-to-day basis. This is the body that is mandated to supervise and run the fund on a day-to-day basis. Of course, it is comprised of the principal secretary for the Ministry of Finance, then the principal secretary from the Ministry of Social Security, then 7 people appointed by the Cabinet Secretary, 2 persons from an organization, employers organization that is of high representative, 2 persons of opposite gender who are from an workers organization, employers organization, workers organization, that is the likes of FKE, COTU, such kind of organizations. And then 3 persons, one of whom shall be of opposite gender, not being public officers, nor employees or directors of any public company appointed to the Cabinet Secretary. So those are the individuals who are to be appointed by the CS, plus the principal secretaries. Those will form the Board of Trustees of the NSSF. This was one of the aspects that had also been challenged under the Employment and Labor Relations Court. But now that is what under the bridge. Those are the trustees, as will be appointed by the Cabinet Secretary and seconded from the particular ministries that I've mentioned. So these trustees will work hand in hand with the CEO of the fund. So the CEO of the fund is under the NSSF Act referred to as a managing trustee. So the managing trustee, who is also the CEO of the NSSF fund, will sit at the board amongst the other board members, and his main role will be to report back to the board, ensure contributions are paid by members in full and on time, determine the benefit claims and make payments, then refer and defend before the tribunal any claims. So any claims that are brought against the NSSF Act will be brought before the tribunal. And this tribunal under the Act is a tribunal established under the Retirement Benefits Act. So there's a lot of correlation between RBA and NSSF. So now the tribunal that will handle any claims for benefits or any other form of claim concerning NSSF is the RBA established tribunal. These are just some of the roles. There are many other roles that the managing trustee has under the Act. I've just mentioned a few. And the board is mandated within 6 months after the end of every financial year to prepare and submit to the Auditor General. So number one, they prepare and submit a balance sheet of the fund showing the assets and liabilities of the fund, statement of income and expenditure of the fund, and then statement showing segregation of the pension, provident, and all provident fund. So they've got to submit a statement of contributions into the pension fund for both tier 1 and tier 2, contributions into the provident fund, contributions into the all provident fund. They've got to submit these yearly to the Auditor General. So once these statements have been audited, the NSSF is required to publish the audited accounts in 2 newspapers of nationwide circulation within 3 months of conclusion of that audit process. So from here, you can tell that NSSF is not submitting their reports to RBA, but it is submitting to the Auditor General for purposes of auditing. So supervision is done by the NSSF board, comprised of the individuals that I mentioned. Management is done by the managing trustee, who is the CEO of the fund, and audit of the fund is done by the Auditor General as provided in the fund, in the Act. So now let's move on to access of funds. How do members, or let's call them employees, access funds after their employers have remitted these funds to the NSSF? So number one, there is access upon retirement. So now under retirement, there is a retirement upon attaining pensionable age, which we normally call a normal retirement age. The Act refers to it as pensionable age, that is 60 years. And one can also attain retirement on early retirement grounds at 50 years. So long as you are an employee whose contributions are being made by an employer, then your contributions are going into the pension fund. And because they're going into the pension fund, you are only allowed to access a third or to commute a third as lump sum from tier 2 contributions. And then the balance is used to purchase either a pension or an income drawdown from an insurance company of your choice. NSSF does not compel it or require you to purchase from a particular insurance company. It's an insurance company of your choice. You either buy a pension or an income drawdown. The pension, of course, has got to have a guarantee of 10 years, got to be a lifetime pension that is non-commutable, we cannot transfer, non-transferable, and it's got to have a guarantee period of 10 years for the pension. And then the other option is income drawdown. So for individuals who are contributing into the provident fund of NSSF, because we say there are 2 funds, pension and provident, these are individuals who are contributing on voluntary basis. And these are individuals who by law should be self-employed. If you're self-employed, you can contribute into the provident fund. But if you are an employer, you only contribute into the pension. And for the ones who are contributing into the provident fund on a voluntary basis, they can access these funds upon attaining 50 years as a lump sum. So there's no issue of a third and 2/3. They access the money at 50 years as a lump sum. And then there's what we call invalidity pension. This is payable as a lump sum when a member or an employee or now definitely a member of the scheme suffers physical or mental disability of a permanent nature resulting to total incapacity. But this has got to be certified by a medical board. The Act actually says that NSSF will set up or will partner with certain medical boards and refer their members to these medical boards, who will then certify them as having been invalid before they can access these monies. There is a catch. If you have been a member of NSSF, the pension fund, and you have been contributing for not less than 36 monthly contributions, then the benefits are far much better than a person who has contributed for less than 36 months. If you've contributed for 36 months and more, the benefits are better, and those benefits are calculated in terms of the tier 1 contributions. They look at the tier 1 contributions, and there are certain additions that are made to the tier 1 contributions under the Act. I don't want to venture into that, quite technical, but under the tier 1 contribution, there will be certain benefits if you have contributed for more than 36 months and you've become invalid. If you're a member of the Provident Fund and you become invalid, then you're entitled to a lump sum. But even with that entitlement to a lump sum, that invalidity or the not being able to work or the incapacity has got to be determined by the medical board. So the medical board has got to confirm that before you claim invalidity to get a lump sum of your total pension fund benefit that has accrued over the years. Then there is what we call the survivor's pension. This is what we call the death benefit. So there's a lump sum that is payable to a member's dependents upon death of the member who dies before attaining the pension upon age. That is 60 years or early age of 50, and who at the time of his death had made not less than 36 monthly contributions to the fund. 6 monthly contributions, the benefit to your members or to your dependents or to your beneficiaries will be better, will be far much better. But the payments are to be made within 1 year after the death of the member. The law says within 1 year. So they are not immediate payments, they're made within 1 year. Of course, the claims have got to come in. The Act also allows for the nomination of beneficiary forms to be submitted to NSSF. In fact, they say it needs to be updated annually. So it's important that even as we become members of this fund, even before the opting out, and even with the opting out, still there will be tier 1 contributions. So even with the tier 1 contributions that will remain at the NSSF, let's fill in these member beneficiary forms so that NSSF does not struggle, because the Act says that the requirements or the provisions of the succession, the law of succession, shall not apply to this particular Act. Same thing as the RBA Act. So your dependents cannot go to court. The trustees will make a determination. And if the trustees are to make a determination, it is easier when they have a member beneficiary nomination form duly filled out and a current one for purpose of transfer of these funds within 1 year of the death of the member. So in the event that you have not been contributing or you have not contributed for 36 months, either for the invalidity or for survivor's pension, then what your dependents will get is a lump sum benefit or equal to the member's pension fund credit. That's what they will get. That additional benefit of tier 1 calculations will not be made if you have contributed for less than 36 months. But if you contributed for more than 36 months, there's an additional benefit. So dependents of Provident Fund members will be paid a lump sum equal to the Provident Fund credit at the date of death. Then there's something called withdrawal benefit. This withdrawal benefit only applies to Provident Fund members. It does not apply to pension fund members. And Provident Fund members are entitled to a withdrawal benefit equal to the member's Provident Fund as at the date of withdrawal if they no longer are in self-employment. You may be in self-employment, you have run through hard times, you are no longer in self-employment, you can no longer run that entity that you are running as a self-employed person. You can actually go and apply for a withdrawal benefit, but then you've got to demonstrate that you're no longer in self-employment. This only applies to Provident Fund members, and who we have said are people who contribute on a voluntary basis and are self-employed. Then there's a funeral grant. So this Act has introduced the funeral grant. It's payable as a lump sum of Kenya shillings 10,000, payable to the beneficiaries on death of a member who has paid at least 6-month contributions. So if you've paid 6 monthly contributions into NSSF, and God forbid, an employee or a member passes on who has made 6 monthly contributions, Then their beneficiaries will get a lump sum of 10,000 to assist with the funeral arrangements. And this claim needs to be made within 60 days from the date of death of the member. So the claim needs to be made within 60 days. The member passes on, make a claim within 60 days. The member needs to have contributed for 6 months. NSSF will pay a lump sum of Kenya shillings 10,000. And this is over and above the survivor's benefit. Then we have the immigration benefit. This is payable as a lump sum to the member, being an amount equal to their pension or provident fund. If you are a member of the pension, if you are a member of the provident, you get an amount equal to that fund, what you are contributing to that fund. If the member is emigrating from Kenya to a country with no reciprocal agreement. So the Act provides for countries that have reciprocal agreements and others that will have reciprocal agreements in future. So you've got to be migrating to a country that has no reciprocal agreement with Kenya for you to get these funds under immigration. So claims for payment of fund benefits are processed in accordance with the NSSF Act Regulations 2014. And we have noted that the Act and regulations do not provide for timelines for payment of claims, save for death, which we have said is within 1 year, and funeral payments, which we've said the claim should come within 60 days. But even after you claim, the Act does not say within what number of days will you get the payment. So that there's a lacuna there, and that probably needs to be worked on, so that then we have specific timelines for payment. So thank you very much for listening to me. That is in a nutshell, a review, a breakdown of the NSSF Act 2013. Back to you, Florence.
Thank you so much, Stella. We greatly appreciate that presentation. We will proceed to the next presentation by Ruth Njuguna. And then after that is when we will do the Q&A. So Ruth, if you can hear us.
Thank you, Davis. I can hear you. So let me just try and start my presentation. Please confirm that my screen is visible.
Confirmed, Ruth. Proceed.
Thank you. Stella has covered a lot of the elements as far as the Act is concerned, but I'll try and make it simple specifically for the purposes of implementation. So the Act has come into force end of February 2021. Basically, why the new fund? It provides a number of objectives that are enhanced from the previous. Basically, is to try and improve social security. And in improving social security, we are increasing membership coverage, improving adequacy of benefits, and we'll see why through the enhanced contributions and also the locking in of benefits and accessing of those benefits in form of a pension, allowing employers who have an existing pension fund to continue with their contributions, provide a vehicle for self-employed persons to access social security for themselves and their dependents, and also operate and manage a scheme that is value adding to its members. So the key things that you really need to know as an implementer, employee, employer, is basically the three key things, which is the lower earnings limit, which is defined as the average statutory minimum wage. And this will be progressive every single year based on for the current first 5 years is pegged on the schedule that has been provided within the Act, and thereafter will be gazetted on an annual basis by the Cabinet Secretary based on the Kenya National Bureau of Statistics report. The upper earnings limit, which is defined as 4 times the national average earnings, and then pensionable earnings, which is the lower of the members' monthly wages and the upper earnings limit. And I will provide demonstration or sample computations just to make this easier. So for Tier 1 contributions, we are saying it is 6% of the pensionable earnings up to the lower earnings limit. and it will be determined progressively as follows. So you can see for the first year, it's 6,000 shillings, 7,000, 8,000, and from the fifth year onwards, it is going to be the actual minimum basic wage, and 6% of each of the respective lower earnings limit has been defined. And that is where we are getting tier 1 contributions as what we call the 360 shillings. Then we move to tier 2. It is 6% of pensionable earnings above the lower earnings limit, but subject to the upper earnings limit, and the progression of the same has been defined. So the Act provides for the different categories running from the first year to the fifth year. The first year, the upper earnings limit is 50,000 of the national average earnings as per that particular schedule, which is 36,000, and it equates to the 18,000 shillings. So 6% of 6% of 18,000 less the lower earnings limit, which is 12,000, we get 720 shillings, and respectively. So let's look at an example of tier 1 and tier 2 respectively on actual earnings. So we have different individuals who have different salaries. So scenario 1 to 9 defines the pensionable earnings for the different categories of salaries. So we can see that from the scenarios, we have people earning between 3,000 shillings and 500,000 shillings. That is the first column. The first column basically defines the salaries, the actual salaries that those employees earn. So it is ranging from 3,000 shillings to 500,000 shillings. If you go to the second, or rather the third column, it is showing pensionable earnings. And pensionable earnings are the difference between the upper and the lower earnings limit. Then we apply on the second on the second box, the first column. We are seeing tier 1 pensionable earnings. So anybody who is below the 6,000 shillings, we apply 6% of their actual earnings. But the question is there anyone at this point in time earning less than 6,000 shillings? So we will assume everyone, all the employees that we are using from our scenario analysis, will be earning, or rather their pensionable earnings for tier 1 is 6,000 shillings. And you can see it is 300 shillings consistently to the last person, because the capping on tier 1 is subject to the lower earnings limit. When you move to the third box, where we are looking at a computation of tier 2, and tier 2 we said is the difference between the upper earnings limit and the lower earnings limit. And let's take an example of someone, scenario number 4, someone who is earning 10,000 shillings. Their pensionable earnings for tier 1, which is the lower earnings limit, is 6,000 shillings. We've already expended that, and they are paying 360 shillings. So their tier 2 contributions are going to be pegged on a pensionable earnings of 4,000 shillings. Remember, we have already utilized 6,000 shillings for tier 1 contributions. So whatever is remaining from their pensionable earnings, which is 4,000 shillings, is what we will subject to tier 2 contributions. And you can see the amount effectively comes to 240 shillings. So that's a number 1 example. Let's look at someone who has an amount over and above or equivalent to the current upper and lower earnings limit. And scenario number 6, you can see the employee earnings is 18,000 shillings. Tier 1 pensionable earnings for that particular individual is 6,000 shillings, and therefore they will contribute 360 shillings. If you move to the third box under tier 2, that is scenario number 6, we have already, out of the 18,000 shillings employee earnings, we have already utilized 6,000 for tier 1 contributions. So we are effectively left with 12,000 shillings as pensionable earnings, where we base our tier 2 contributions, and therefore we are getting 720 shillings. So you have heard all through from the different platforms that effective end of this month, we shall be contributing a total of 2,160 shillings from both employee and employer. And that 2,160 shillings is the 360 shillings from Tier 1 and 720 shillings from Tier 2, both for the employee and for the employer. So we move to another example of scenario number 8 of someone earning 100,000 shillings. And just to bring it home, I will look at a different, a clearer example. So a member earning a monthly salary of 100,000 shillings will contribute as follows in the first year. So we have said Tier 1, the pensionable earnings for the purposes of applying Tier 1 is the lower earnings limit, which is regarded as 6,000 shillings for the first year. And then Tier 2 will be the pensionable earnings, which is the difference between the upper earnings limit and the lower earnings limit. The upper earnings limit for the first year is 50% of the national average wage, which as per the first year schedule, 36,000, and that is where we are getting 18,000. So you can see the total pensionable earnings for the purposes of Tier 2 contributions is 12,000. So this is an example of someone who exists within either an occupational or an umbrella scheme, and in the event they are given or they're approved for the purposes of opting out. For the purposes of illustration, I will assume that the current contribution rates are 10% and the employer is doing 20%. So the total pension contributions for this individual is going to be 10,000 and 20,000 employer respectively. So Tier 1 becomes 360 shillings. So where did we get the 360 shillings? It is 6% of the pensionable earnings for Tier 1, which is 6,000. Then Tier 2 contributions become 6% of the pensionable earnings for Tier 2 contributions, which is 12,000. When you add those two, it is 1,000 shillings and 80. Then whatever is remaining from the actual 10,000 is what we will come to the contract, to the existing scheme. This is before contracting out. So remember, Tier 2 is what is eligible for contracting out, but that will only be applicable subject to getting a reference scheme certificate approved by the Retirement Benefits Authority. So you can clearly see the illustration, and you can see at the bottom I have indicated Tier 1 goes specifically to the new NSSF fund. Tier 2 can go to either, which means you can progressively continue to remit to NSSF, but you have the option of opting out once it is approved by the regulator. And Tier 3, or rather the normal contributions, which we are alluding or calling it Tier 3 for the purposes of ease of understanding, will continue to go through the existing scheme that is currently being managed by the Retirement Benefits Authority. So this is an illustration of year 1 for someone earning a salary of 100,000. So in the first year, the amounts for Tier 1 and Tier 2 are relatively minimal. So 360 shillings, 720 shillings, a bit low. Let's look at an illustration of year 3. All factors held constant. We are assuming that the rates will remain. There is not going to be any amendment to the current act, and it will be implemented as is. So Tier 1, for the purposes of illustration, the pensionable earnings then in year 3 is going to be 8,000 shillings. Tier 2, the pensionable earnings is going to be the difference between the upper earnings limit and the lower earnings limit. And the upper earnings limit then has been provided as 2 times the national average wage, which is 36,000, and that is where we are getting 72,000 from. And the lower earnings limit, that's supposed to be 8,000 shillings, is supposed, so the total, the total pensionable earnings for Tier 2 contributions is 64,000. Using the same scenario analysis for someone earning 100,000, today, if they are contributing into a pension fund, 10%, 20% employer, the total pension contributions, irrespective of what the investment vehicle is going to be 10,000 and 20,000 effectively. So tier 1 contributions in the third year is going to be 6% of 8,000 shillings, which is 480 shillings both for the employer and for the employee and the employer. Tier 2 contributions is going to be 6% of 64,000 shillings. And therefore, tier 2 contributions, you can see, will be at 3,840 shillings. So look at the impact of the normal contributions going into the current fund. It has reduced drastically to almost half. And the question is, at what point would you rather your contributions go into the National Social Security Fund or apply for opting out so that you utilize material value from what is coming into the fund? I said, if I look at an example of someone earning 100,000 shillings for the first year, you realize tier 1 and tier 2 contributions are low. So the impact is almost negligible on the normal contributions going into the fund. But progressively, looking at how the bands are growing, it begins to have an impact on the growth of any existing scheme that is within the growth of the retirement benefit sector. However, the positive side of it is that the pension savings for any individual, whether you're doing it through NSSF or doing it through the scheme, is enhanced and therefore improving adequacy for the purposes of access of pension at retirement. So like I said in the previous example, tier 1 is allowable mandatory to go to NSSF. Tier 2 is either NSSF or an existing scheme subject to approval for contracting out. So what are the benefits payable through the new NSSF Act? And just to make it simple is that in the existing regime for occupational schemes, umbrella schemes, and personal pension scheme where we have a participating employer, the law has been allowing that on early leaving, a member can access up to 50% of their total benefits. So anything that is regarded as protected rights, and protected rights is tier 1 and tier 2 contributions, will not be accessed until early normal retirement age or other special occurrences beyond our control, which is either permanent immigration, ill health, and death. And therefore, it effectively means between now and age 50, any person who exits either through dismissal or resignation cannot access any of the funds that is in tier 1 or tier 2. Even if you wish to transfer those funds, the recipient fund must be credited for the purposes of accepting tier 2 contributions. And the reason why the regulator is requesting that we must fulfill those conditions is that any registered pension scheme must demonstrate that they will adhere to the requirements. I think Stella has already covered the circumstances under which permanent immigration, ill health, or death, the benefits are payable, and I would want to delve deeper on that. So other than the grounds of access of benefits, so basically, let me just to also add on this, it means any contributions that are above tier 1 and tier 2 automatically will be, the benefits payable will be in line with the nature or the structure of the fund and the trust deed provisions as far as access of benefits is concerned. So whatever is called tier 3 that we have defined will continue to be accessed in the manner that the current trust deed has provided. Other than the actualization of the approved exit grounds, the new tier 1 and tier 2 benefits must be accessed in form of a pension fund. So even if what the existing fund is a provident, you must apply and review the relevant paperwork to include an element of a pension scheme. And therefore, Tier 1 and Tier 2 contributions at the point of access. A third will be accessed as lump sum, and 2/3 of the benefit will be used to purchase an annuity or an income drawdown, basically what we call a monthly pension. So if the total of your Tier 1 and Tier 2 contributions are, say, 3 million shillings, you will take 1 million as lump sum, and the remaining 2 million can only be commuted in form of a monthly pension, which will be equivalent to, say, around 20,000 shillings a month. And the annuity or the income drawdown in question that an individual will be purchasing must be either payable for life or must be provided for with a minimum guarantee of 10 years. So notice the difference in terms of both the grounds for access of benefits and the options allowable for the purposes of benefits access. In terms of taxation, this still remains as one of the gray areas, but subject to the provisions of the current NSSF Act. It is alluding Tier 1 and Tier 2 contributions, fully tax deductible. Investment income may be tax-free, and all of the pension or retirement lump sum that results from consolidation of Tier 1 and Tier 2 contributions are going to be tax-free. Like I said, based on the current NSSF Act, that is the provision that exists. I mentioned it may be one of the gray areas that may be subject to change later, but as of now, taxation of benefits, both at a contribution, income, and benefits level, is not subject to any tax whatsoever, subject to the income tax provisions. So as a result, there is another key element that we need to be aware of, which is called contracting out. And a contracted out scheme basically means either an occupational scheme is standalone scheme that has been set up by an employer or established by an employer for the benefit of his employees. So a pool, or an umbrella retirement benefit scheme. An umbrella is basically many small and medium-sized organizations coming together through a retirement benefit scheme to save for and ensure that they benefit from the economies of scale, or an individual retirement benefit scheme which has been approved and registered by the Retirement Benefits Authority for the purposes of receiving Tier 2 contributions. And where applicable, any Tier 2 fund credits transfers from the fund. So once a scheme has been approved for contracting out, if an employee ceases to be an employee of Company A and they are transferring to Company B, for them to transfer Tier 1 or Tier 2 fund credits, for Tier 2 fund credits, the recipient scheme must also be approved for the purposes of contracting out. So what does contracting out entail? It entails something we call a reference scheme test. So that is a quality standard that the regulator will be using to assess whether a scheme is approved for contracting out or not. The Retirement Benefits Authority issued a statement and defined or provided a standard, something called Form C1, with certain requirements that any scheme that intends to opt out must comply with. So you'll make an application through the Retirement Benefits Authority, and you will be able to confirm your status of approval or non-approval within a period of 60 days. So one of the requirements under for the purposes of approval is that the scheme that is applying to opt out must be registered by the relevant regulatory bodies. Specifically, it must have a certificate of registration with the Retirement Benefits Authority, which effectively means that it has complied with the regulations and the requirements as far as setting up pension scheme is concerned. The same is registered with the Kenya Revenue Authority or the Income Tax Department for the purposes of tax exemption. and consequently applies with the provisions of the Income Tax Act. The scheme must also demonstrate that it complies with the investment guidelines as provided for within the Retirement Benefits Act as far as investments is concerned, and this will mainly be demonstrated through a valid investment policy statement that is signed off by an actuary and the board of trustees that is managing the fund. The scheme must also demonstrate capacity and commitment to maintain protected rights as per the Act. What does this mean? When you review your trust deed and rules, first, it allows or commits for the benefits to be accessed only in the manner provided for in the new NSSF Act, and I think I have provided the 5 scenarios. It also allows or commits for members to access benefits in form of pension as guided for by the Act. It also means that when you review your trust deed and rules, you will define the contributions regarded as Tier 1, which will be protected rights, will only be maintained in manner as required, or rather segregated, for the purposes of ensuring that members do not access it beyond the limitations that have been provided, and any recipient scheme, or rather any recipient member bringing in their benefits, will comply with the provisions of the new NSSF Act. So how you will demonstrate that capacity is by amending the trust deed and rules, which grants it power to commit to maintain the protected rights as per the retirement benefits, as per the NSSF Act guidance. So what next is with this new, or rather the effective implementation of the new NSSF Act? It basically means that the current contributions of 200 shillings that have been going to NSSF, which is Tier 1, is going to increase to 360 shillings, and therefore an obligation of an additional 160 shillings will have grown for both employees and employers respectively, and this will be remitted effective end of the month. Any employees who will be earning above the 6,000 shillings means that Tier 2 contributions will be remitted to NSSF as well. And therefore, for any employer who does not have or has not been providing any form of retirement benefits, it means there is an additional, over and above the 360 shillings, there is an additional liability of 720 shillings for the first year. And consequently, of course, the liability continues to grow. For any employer who has an existing scheme or has been providing retirement benefits, it means this amount will be incorporated, or rather will be considered within the current pension contributions. And therefore, Tier 1 and Tier 2, the presumption is that for the month or for the next 2 months can only be remitted to NSSF subject to acquiring a contracting out certificate. So once you receive the contracting out certificate is when you can be able to start channeling the contributions through the new scheme. And of course, the National Social Security Fund, in terms of compliance, will require you to provide them with a certificate confirming that position. So opting out will also be done within the next 60 days, or from the point the employer or the sponsor or together with the trustees agree or make a resolution for the purposes of contracting out. So depending on the level of monthly contributions and where they have been going to, you will determine whether to contract out to an existing occupational scheme. That is if one exists for the scheme, or join an existing pension scheme. For most of the small and medium sized organizations, this is going to be the most appropriate vehicle. If you do not have an existing one, and for the purposes of benefit for your employees, you would be remitting through that structure, and individual pension plan for any self-employed persons who may wish to remit Tier 2 contributions, subject to them confirming that indeed the personal pension in question has been granted opting out. And therefore, it would be important that the implementers, whether the sponsor, the trustees, and any other party who has an interest in implementing, to appoint a consultant or seek professional advice for the purposes of implementation. I believe administrators in this market and other legal advisors exist to help or support or facilitate at a small cost to ensure effective implementation. So that's it as far as the implementation of the new NSSF Act is concerned. I'll leave it at that so that we may allow for the Q&A session. Thank you.
Thank you very much, Ruth and Stella, and for a good presentation. Just to say that is our General Manager, Client Services at Octagon Pension Services Limited. Just allow me to introduce her because she immediately jumped in after Stella, and she has worked at different levels within the pension industry for over 12 years, and she has a wealth of experience in management of retirement benefit schemes. Professionally, she has practiced and offered services for various organizations, from pension consultancy, administration, strategy and transformation, organizational performance, quality management, customer service, and relationship management. So she is quite exposed with a wealth of experience in terms of retirement benefit schemes. She's also a member of the Pension Management Institution UK, and academically, Ruth holds an MBA in finance from the University of Nairobi, a diploma in employee benefits and retirement savings, Pension Management Institute of the UK. She's also a certified trainer and actually trains at the College of Insurance, and she's also a trainee for Trustee Development Program Kenya, TDPK. At the College of Insurance. She has a BSc Actuarial Science from Jomo Kenyatta University of Agriculture and Technology. So that is Ruth for us, and she has undergone various trainings to sharpen skills and leadership transformation, organization performance, quality assurance, and customer experience. And for those who could have logged in and are our trustees, you're familiar with Ruth Juguna, who has interacted with you in a wide range and in diverse ways in the various trainings that we have undertaken. Now, before we jump into questions and answers, which Elizabeth Wanja is collating, because the questions are rather too many on the wall, and thank you very much for those questions. We appreciate that. Gives us confidence that we are all together as much as we are such a large group. I'll allow Davis Ongiro, our General Manager in terms of business development, to quickly jump in at this particular point, because there is one single thing that he would like to tell each one of us this afternoon. Over to you, Davis. Just a minute. Davis is getting on board.
I think thanks so much, Florence. Sorry, I had a challenge in the internet. Thanks, Ruth, also for the presentation. I think what I wanted to say just will take a minute. We have had presentation both from Stella and Ruth, and most of us, especially in the chat section, are wondering what are we supposed to do? What is the next course of action? There are two options that are available. One, of course, is to be able to look at whether you have a scheme currently for purposes of tier 2. In short, what we are saying is tier 1 is a must. You must comply immediately. And when you are complying immediately with your payroll, which is from February, tier 2, you might also want to make a decision whether you want that to go to a private pension scheme or be able to take that to NSSF. That is a decision that comes to the table. There are so many discussions that go through your head before you make that decision. But most employers, we have seen the discussion is going that they want to contract out tier 2 to private pension schemes so that then you can also gain from the advantages of having your tier 2 managed by a private pension scheme. That could include better returns and efficiency in terms of servicing, and also in terms of governance for purposes of your funds. So you find that private pension schemes have gone an extra mile to be able to provide a better service when it comes to servicing for you as a client. So we are ready to work with you through the journey. If you want to contract out the tier 2, we can even help you out to contract tier 2 and also give you an avenue for you to contract that tier 2 too in terms of a fund through our Octagon Umbrella Retirement Benefits Fund and or through our Octagon Personal Pension Fund, both of which are licensed by Retirement Benefits Authority. We have both schemes at as we do proposals to you, you are able to appreciate that the returns are better, the governance is better, and you can be able to be excited that all of us, even as we work very hard to ensure that we have a better retirement, we also ensure that we have a sufficient income replacement when it comes to preparing for retirement. So we are very much ready and available to be able to assist you as an employer, as the HR manager, as the finance manager, as the CEO of your company, to be able to walk you through this journey. If it is an existing scheme, we can discuss what to do, but also for those who want to join the retail side in terms of contracting out the tier 2 contributions, we all have something that is tailored for all of us. So ladies and gentlemen, I think we have also given we will provide our phone numbers and our email address at the chat section so that after this training, or in case you need these presentations, but also in case you need us to do a presentation to your team so that you understand this better and customized specifically for your organization, will be very much available to be able to assist and be able to provide a solution that works best for you as an employer or as an employee. Very much appreciated. Over to you, Elizabeth.
Thank you so much, Davis. Thank you, Florence. Thank you, Ruth and Stella, for the wonderful presentation. I will go through a few questions. So Orlando asks, does contracting out apply to provident funds too, or is it just an option for pension funds?
I've introduced that friend.
I will repeat the
so-
question. Sorry. Oh,
Sorry,
okay. You've heard it.
I have had the question, Elizabeth.
Okay.
So just to be clear is that even if you have an existing provident fund, the whole essence of you reviewing the trust deed and rules is to ensure that you amend it in respect to appreciation of the pension fund design, and therefore submission to the regulator and amendment of the tool that sets up that trust allows it for the purposes of access of pension. So it will basically be a hybrid of pension and provident. I have seen a related question that for existing schemes that have, for employers who do not want to increase their pension contributions as per the current trust deed and rules, what happens? Remember, based on the new NSSF Act, the mandatory contributions to be provided for under that act is 6% of the upper earnings limit and the lower earnings limit. So unless the contributions that you're currently contributing are below that, I would presume they can be accommodated within the current pension contributions. So employers who are not contributing anything or whose contributions are below that minimum recommended are the ones who would have to accommodate extra liability. For the first 2 years, if say your pension fund contributions are below the 6%, they may be accommodated. But in the long term, the organization needs to do financial projections to ensure that they increase the pension contributions to accommodate the recommendations as per the minimum upper and lower limits. Thank you.
Thank you, Ruth. We have another question from Mercy. She's asking, should a scheme be allowed to contract out? Should a scheme be allowed to contract out? What will happen to the Tier 2 transfers that will have been made to NSSF? Can they be transferred to the approved scheme?
Thank you for that question, Stella here. Yes, what happens to Tier 2 contributions? So when a scheme, when an employer, it's actually the employer who applies. When an employer applies to contract out of NSSF, and RBA, the Retirement Benefits Authority, approves that application, the funds that will have been remitted to NSSF under Tier 2 are by law required to be transferred to the contracted out scheme. And we've said the contracted out scheme can be the occupational scheme of the employer, it can be an umbrella scheme, or it can be an IPP scheme. So long as that contracted out scheme has gotten the green light or the approval from RBA, the employer should apply to NSSF to transfer the Tier 2 contributions. And that application, the law says that NSSF should transfer the Tier 2 contributions within 60 days. The only thing is that with the transfer of the Tier 2 contributions, the law also says that the interest is not transferable. So what is transferable is the principal amount of Tier 2, not the interest. Tier 1 is not transferable. Tier 1 remains within NSSF. Thank you.
Thank you, Stella. So Owino asks, what is the significance of these two tiers? Why not just have a flat rate?
Elizabeth, thank you for that question. So currently the significance of those two tiers is to differentiate between what is the minimum but mandatory that is allowable to go to NSSF and what is the upper limit that would be allowable for the purposes of contracting out. Remember, the current National Social Security Fund as is not adequate, and therefore enhancing those benefits through a phased approach will allow for us to achieve that adequacy. And also the other, the nature of having it in Tier 1 and Tier 2 is basically to allow employers who have existing funds to have the option for part of the monies to go through the existing scheme. Though generally, or rather just my own personal view, I tend to agree with you. It would just have been a standard rate to be allowed to either go through NSSF or a private pension scheme, but that is a discussion that perhaps will come at a future date. Thank you.
Thank you, Ruth. We have Beatrice who's asking, elaborate more on the remittance of NSSF for persons receiving gratuity below 6,000.
Yes, so that's a political question that I will attempt to answer in a political manner, because it is assumed that any person who has employees must adhere to the requirements of the minimum wage, and the minimum wage is assumed to be 6,000 shillings. So ideally, NSSF assumes that anybody who will be remitting funds to them will be remitting 360 shillings on the basis of the minimum wage. Otherwise, at some point, any contributions below the 6,000 shillings, 6,000 salary limit will start to attract material compliance issues with the various regulators.
Elizabeth.
Thank you, Ruth.
Elizabeth, if I may weigh in on that question,
Okay.
The regulations actually do speak on matters gratuity, and they require, just as Ruth has said, for the employer to contribute and to remit. Remember, chances that one is earning below 6,000 is very rare. And even if then they're earning that 6,000 and what they're being paid is gratuity, the regulations require that the employer remits. But then when paying out the gratuity, to deduct that which they have remitted to NSSF. So say if the gratuity was an amount that is higher than what they have paid NSSF, then to remit, to pay to the employee less what they have paid to NSSF in the form of gratuity.
But then, Elizabeth, if I may, I think one of the challenges of gratuity is that it's only determined when somebody leaves, so you don't even know how much it is. So we can't say you are contributing 6,000 as gratuity. Gratuity is an amount that is determined at normal retirement age or at the time when somebody leaves the organization. And what we are advising employers who have gratuities today is convert them into that very particular NSSF contributions and better benefit for the employee. It defeats purpose if you have gratuity that maybe is about 15 days for every year worked, which is something like about 3% of salaries. Yeah, when you are supposed to contribute 6%. So the best thing is contribute 6% of the salary as contribution of the pension of wages, pension of wages as contributions to NSSF or to your occupational scheme or umbrella fund, and that becomes the gratuity. I know we have a challenge with the unions arguing about this, but gratuity is one of the worst benefits that is ever given to employees because of tax. And because sometimes it sits on the balance sheet of employers, so there is the element of not being able to be paid if the employer goes into financial challenges. Yeah, so I think my thinking is if you have a gratuity, convert it into a pension scheme. Yeah, convert the 15 days for every year worked or 20 days for every year worked into a pension scheme contribution, and therefore it helps you to be able to fund your NSSF. Thank you.
Thank you, Fred, Ruth, and Stella. That is Fred Waswa, our Group CEO, Octagon Africa. I know we have passed the time which we decided to end this meeting, so I will just handle 2 more questions, and the rest will be able to give you an email where you can reach us and our phone number. So the next question is from Jacob. What will happen in the case of employers who are unwilling to increase their overall contributions? Can they reduce contributions to the existing schemes by the extent payable to NSSF Tier 2?
Okay, let me pick that. Yes, that's what we're calling integration. We are recommending that the best way to manage employment cost is to integrate the NSSF contributions into current occupational scheme contributions if you have them. If you have a scheme that is running and you're paying the scheme, so if you are paying 7.5 or 5%, then that 5% will be less NSSF 1, Tier 1 than less NSSF Tier 2. That makes sure that your total cost of pension remains the same, but it's just where it is saved that is different. But the beauty about it is that Tier 2 contributions will basically come into your occupational scheme. And even those who are in umbrella funds, that's also the same recommendation. You can basically integrate with your occupational pension scheme to make sure that your cost of employment is not ballooned. Thank you.
Thank you so much, Fred, for that. I'm looking for a comment here. Yes. How do I access the benefits at retirement from the NSSF pension fund and Tier 2 benefits domiciled in the contracted out scheme? Assumably, if I combine the benefits of Tier 1 in the fund and Tier 2 contracted out by the scheme, which entity will hold the accumulated credit as I wait to exercise my options at age 60? This is from Kelvin.
Elizabeth, thank you for that question. Stella here. Yeah, so each entity will hold the amount that has been remitted to that entity. So NSSF will hold tier one if you're in a scheme that is a contracted out scheme. And then your pension scheme or your occupational scheme that has been established by your employer will have tier two and any other amount that may be over and above tier two. So when you attain 60 years of age, you will access from both entities. You'll access from NSSF, that is your tier one contributions, and you will access from your pension scheme in the normal manner that you access from your pension scheme when you attain either 50 years, that is early retirement, or 60 years, which is pensionable age or normal retirement as per your TDR. So either both schemes will pay you will get payments from both NSSF and your occupational scheme.
Thank you. Thank you, Stella. So Timothy Wamalo is asking, comparing NSSF and Octagon in terms of security, where is our money safe? In a scenario Octagon is declared bankrupt, will we be able to get our money back?
Thank you for that question, and a very valid one indeed. I think both funds, whether NSSF or any occupational umbrella or individual pension fund, is set up through the relevant act, and pension funds in their own nature are one of the most secure form of investment savings. A pension fund in its nature is registered by the Retirement Benefits Authority and therefore is subject to meeting certain requirements. And pension funds are also held separately from both the employer assets and from a bank perspective, from a custodian perspective, are separate from the assets of the bank. And therefore, Octagon as an agent of the trustees or a sponsor in terms of providing administration services does not have access to those monies. They are domiciled within the trust fund, and the only people who have access or the mandates to move or transfer any of those assets are the trustees. And by the virtue of trustees sitting there, they have committed to comply with the regulations which protect the loss or the benefits of the individual members. And therefore, I confirm that the funds would be safe, subject to the requirements or the provisions of what the guidelines has provided, just to secure the benefits for retirement savings. So, sorry, just an addition, sorry.
Okay.
And in the event, say, Octagon as a provider was to go bankrupt, the only thing that would happen, or going under, the only thing that would happen is that either the regulator would demand that every pension fund that is being administered by Octagon Africa to look for an alternative service provider for the purposes of administering their fund, or put what they appoint an interim administrator for the purposes of transitioning those particular schemes to any other registered service provider in the market.
Thanks for that. Ruth, I know the questions are keeping on coming in, so I would advise all of us to keep the conversation going. I have pinned a comment there with our email address, so you can reach out to us at info@octagonafrica.com, and you can also write to us at training@octagonafrica.com, and we'll be there to help you. Our phone number is 0709 986 000. Feel free to call us. Our customer care agents are always on the line, ready to help you. And without much further ado, I will take this back to Florence. Florence?
Thank you, Elizabeth. Once again, thank you very much for each one of you being in this afternoon. I believe we have all benefited out of that training and gathered a lot of information. Someone said knowledge is power, and therefore now we are an empowered team. Just to really emphasize what Elizabeth has said, please channel all those queries to us. We have a fully fledged customer service team that will be able to address those issues, answer your queries, and we are able then to bring you up to speed with what is expected of us with NSSF Act 2013. I wish to take this opportunity to welcome my group CEO to do the closing remarks now that he's managed to join in. Like I said earlier, when we were beginning, I spoke about him. I knew he was going to log in far much later, and we are glad that he has finally managed to log in. Welcome, Fred. We have such a huge team this afternoon, and it would be great if they would hear your voice as you close for us. Thank you.
Thank you, Florence, and the entire team that has organized for this. Thank you for joining us this evening and this afternoon. This evening, we appreciate your presence here, and we hope we have helped. I know it's such a short period for implementation of this act, and there are a lot of issues and a lot of questions. We are here to help you where you need help. We'll be running another program, I think, next week, which is going to be a physical program, which we will encourage that any one of you that has questions, you can come. We'll have a clinic where we'll help HR people to prepare payrolls, because I think that's where the biggest challenge is. I've just this afternoon been preparing somebody spreadsheets for payroll, because that's where the biggest challenge is. We will be having a clinic on that very particular day to do for your clinic. So if you have time, you'll be able to join. Of course, this information will be shared, and hopefully you'll be able to join us in this very particular area. So thank you very much, and really appreciated your presence. Any questions, please put through our info@octagonafrica.com, and we'll be able to respond. Thank you. Thank you very much. Florence?
Thank you, Fred, and thank you, everyone. We wish you a lovely evening, and we hope to see you next week on Friday. We'll be able to send the details on our website, so please log in to get the details. Okay.
Everyone's looking.